Okay, we're going to go ahead and get started. We want to welcome you. My name is Jennifer Young and I'm with University Credit Union. And today's topic of webinar are construction loans. We're going to go over all of the ins and outs and what you can anticipate and answer any questions concerning construction loans. Just a few housekeeping items. We would really encourage you, if you have any questions, go ahead and type them in. You can see the questions tab. Go ahead and type your questions in and we'll stop periodically and address those questions. Anything that has to do with this, and then if you do have other questions relating to mortgages, we encourage you to reach out. You can see on the screen the mortgage department phone number 801-481-8840. That number reaches any one of our mortgage consultants directly. It rings actually at every one of their desks. And so you're always insured on getting a mortgage consultant. If you have any questions, call that number and it'll ring directly for them. Okay, we're going to jump right in and get started and cover. What we're going to be covering today, as I mentioned, are construction loans. We're going to, when would you need a construction loan, why, and what kind of construction programs are available to you from University Credit Union. Really quick, before we go any further, just to clarify, construction loans are the product that you need when you're building a custom home from the ground level up. It's the loan that's used to access funds periodically through the course of construction and pay subcontractors and that. A lot of people come to us and ask if they're going to need a construction loan if they're buying from one of the bigger home builders like Destination Homes or D.R. Horton or Ivory Homes. Those builders typically don't require you to provide construction financing. They provide that for you, and then you would be required to go ahead and just get your long-term financing in place. So that's not what kind we're talking about. What we're talking about specifically is we're talking about the kind of loan that you're looking for if you have found a piece of property and you would like to be building on that property. So just a little clarification there. So at University Credit Union, we offer two types of construction loans. We offer a one-time close and a two-time close. And I'm just going to briefly go over the one-time close so that you understand what that type of a product is. A one-time close is where you close on the construction and the long-term financing loan prior to the beginning of construction. Now you're going to hear me reference that prior to beginning construction a lot, and I just want to clarify to you that particular point prior to construction is a very important point. It's really important that you understand when you're building a home that you don't start construction nothing starts. So no dig a hole, no moving dirt on the property prior to beginning. It's really important. It affects the ability to provide us with a first lien position, and it really causes delays in the long term. So just so that you know, that's a big point that we'll be covering and touching on multiple times. On the one-time close construction loan, your long-term rate is actually locked up front. And so once you're locked in, it's locked for the course of construction and then the long term. So you don't have to worry about it through the course of construction. And you do pay closing costs once. So there's just one set of closing costs, and that saves you a lot in the long run. So if it falls into the category that this is the best option for you, again, just a reminder, close on the construction loan up front, or the construction and the long-term up front. The long-term rate is locked up front, and your closing costs, there's just one set of closing costs. On the two-time close, you close on the construction loan prior to the start of construction or prior to the beginning of construction, and then you close on the long-term loan when the home is 100% done and you have a certificate of occupancy from the city. The long-term rate is subject to current rates when the home is complete, so you don't actually lock that rate in until you're about 30 days from the home being 100% complete. And then we do, at the credit union, we do offer you 0.5% credit back towards those long-term closing costs. We realize that there are a lot of costs involved, and so we do offer you back about 0.5% towards your long-term closing costs. This two-time close loan is particularly relative if you're going to be doing a jumbo loan. So if you're going to be building a home and the construction loan is going to be over the Salt Lake County limit, which is 600,300, you would be required to do a 2-time close. And so this is the type of loan, and we'll go into details on that a little bit later. I'm going to pause for just a minute. We have a question. Thank you, Jenny. Does a construction loan cover buying the land as well as building the home? That's a great question. It does. We can do 2 separate options for you, Jenny. We can offer a lot loan if you don't have a cost breakdown and a set of plans set up and ready. We can go ahead and offer you a lot loan to kind of protect that land and make sure that you don't lose out on the purchase of that. Some sellers are not willing to wait through the time that you are, get a set of plans and a cost breakdown and everything put together. And so if you have somebody that's willing to wait with you and hold on to that land for you and sell it to you all at once, we can do that. But if not, we do have a lot loan available to you. And I'll go into some details on that lot loan a little bit later in the presentation. But yes, we can include that, hopefully. And that was a really good question. Thanks, Jenny. Appreciate that. Just some specs on the construction loan itself. So just so that you know, interest rates on your construction loan are low. And during the course of construction, you're only required to make interest-only payments. And those the interest is calculated on the funds as they're drawn. And so just to give you an idea of what I'm talking about, if you have a construction loan of $400,000, and when you first close on it, we're advancing about $25,000, your first month is only going to be figured on, the interest for the first month is only going to be figured on what's drawn. So you would only pay interest on that $25,000. And say halfway through you've drawn about $200,000, you're only going to be paying interest on the funds as they're drawn. And so just know that you're not going to have to pay on that full $400,000 until that full amount is actually drawn. Hope that makes sense. So interest-only payments through the course of construction. And we offer 6-month, 9-month, and 12-month terms on our construction loan. We do offer a little bit longer if you are building a significantly larger home, and we do see that it's going to take a little bit longer time. We recognize that here in Utah, we do have weather conditions and things that we have to take into consideration. And so we will consider those, that they're really on a case-by-case basis. So we really like to hold our construction loans to that 6-month, 9-month, or 12-month terms. We do offer financing up to 95% of the loan to value or the loan to cost, whichever is most restrictive. Now, when I reference loan to value, your home will be appraised subject to completion. And so whatever that value is established by the appraiser, if that's higher than the cost, then cost is the most restrictive. But if it's lower than the cost, then the value would be the most, whichever one is going to be the most restrictive. We do offer loan amounts up to $2.5 million. And again, here's the little asterisk. We will go higher than $2.5 million, but we'll do it on a case-by-case basis and evaluate it. Sometimes when they get over that $2.5 million mark, we have to go to our construction department, or our commercial department. And so you may be at that point, we may refer you over to our commercial lending department to help us out and take care of that if it's over that $2.5 million. And we do require that on construction loans that this is your primary residence or a secondary home. We don't offer construction financing for investment properties. We restrict that to just primary residence and second homes. So that just gives you an overview a little bit of what construction loans, kind of the terms and that of the construction loans. Now this gives you an idea of kind of side by side what the comparisons are. And on this you can see again the one-time close, closes once, you lock the long-term rate up front, and the loan amounts are restricted, as I kind of alluded to earlier, the loan amounts are restricted to your county loan limits. And so on this, in this situation, Salt Lake County is $600,300. All of the other counties in Utah, with the exception of Summit and Tooele, are limited to $453,100. And then Summit is actually $679,650, and Tooele is the same as Salt Lake. Tooele is the $600,300. So just know that that just is kind of a brief rundown that if you're over those county limits, then you're going to be looking at a 2-time close. That will be your option. And the 2-time close, you close twice. You close once on the construction loan, and then when the home is 100% complete, you close on the long-term. Your lock-in on the long-term rate is when the home is finished. We'll lock about 30 days from the completion. That's as long as we'll go out on those. Loan amounts can exceed the county loan limits, so you can go over the $600,300 for Salt Lake, and you can actually go up to the $2.5 million and over that on a case-by-case basis. And like it indicates here, loan amounts over the $2.5 million typically will go through our commercial loan department. So this just gives you kind of a look-see, a comparison side by side. Terry has a question, and I'm going to address that. What if we want to do a tear down house where we are in and rebuild? That's a great question, and this is the perfect opportunity, and this is the product that you will need, Terry. To do a tear down, what you actually do is we're going to look at it as whatever the new value is. So you're going to have a set of plans that you've worked with either a builder or an architect to put together, and we'll assess with the cost breakdown, we'll assess what the new value will be. We won't look at what the existing value. We do look at what equity you have in your home right now and put that equity towards whatever the required would be for the down payment for the new loan. So you would be subject to the same qualifying as you did initially when you first bought your home. We would just be doing it now off of the proposed improvements, just like what you're talking. And really the tear downs feel like it's a totally new construction. The only difference is you already own the property, and like you said, you're doing a complete overhaul and rebuild. So those are really fun to do. I hope that answers your question, Terry. So we want you to be prepared for the process that you can anticipate for the course of construction, and just be prepared for what you can anticipate for being approved for the loan, what you can expect as far as our requirements and our expectations. And so we're going to run through just a brief overview of the process. We require that you have a general contractor involved. We do not offer owner-build transactions on our construction loans. We feel like it's in the best interest of our members to go ahead and have a general contractor, and the assurance of having them insured and licensed and in good standing with the state construction registry. These are all very important things to us, and construction loans are a risky loan, and so we require that you have a general contractor. Now, that being said, we do get asked from time to time, do we require that the general contractor be on our approved list? No, we do not. But what we do require is that your contractor provide us with information so we can evaluate their overall strength and reliability. We want to make sure that their license is in good standing and that they have the proper insurance that they're required to carry. We also make sure that they're in good standing with the state construction registry, just to make sure that they're doing what they're supposed to be doing so that you don't get involved with someone that is going to take advantage. We want to make sure, our job is to make sure to help protect you. And so we require that they provide us, excuse me, with certain information. Next, we're going to go through and we're going to require all of the documentation that you would normally be required to buying an existing home. We're going to ask for that information, and then we're going to ask for additional information from you as well as from the builder. We're going to ask for a set of plans, a cost breakdown. We're going to ask your builder to provide us with information like his license, a copy of his insurance. We're going to ask to make sure that he's in good standing with the state construction registry. You'll hear me refer to that often, and we refer to it as the SCR. Utah is unique in the industry to having the state construction registry, and they are an added level of protection. They protect not only you, the homeowner, and the builder, but they also protect all the subcontractors and the suppliers, as well as us, the lender. They protect everybody involved in the transaction to make sure that they get paid. There have been problems in the past with people getting left out when final payments were made, and the SCR ensures that everybody has a right to get paid on a job that they've performed work on. And so we just check to make sure that we're in good standing and that everything, the information, all of the information that we gather supports all of that. So just know that we're going to collect a lot of information to ensure through the process. Terry, I see that you have a question, and I'm going to have you hang on for just a second, and I'll come back to your question. After we've collected all of your information, we issue what's called a preliminary loan approval. And on that preliminary loan approval, it just says that we've evaluated your information and we feel comfortable moving forward. And at that point, what we'll do is there might be some additional information that's required from our underwriter. They may come back and ask us to clarify some information or get some information. But at that point, you know that you're qualified and we can move forward with the process. We order an appraisal and title, and they're just a little bit different on a construction loan than what you typically have when you're buying an existing home. When you buy an existing home, they can go out and they can walk through the property, and title can see a history on the title. But when you're doing a construction loan, we're doing it subject to something being built. And so it's really important when you provide us information, when you provide us the cost breakdown and the set of plans, that you really are addressing the finishes, the quality of finishes. We want to make sure that you're getting full benefit for the money that you're spending. And so we want to make sure that we're addressing what type of countertops you're getting, and are you doing upgraded cabinets, and are you doing upgraded flooring, and are you doing, you know, two-tone painting? There's so many things that go into it. And so we want to make sure that we know those things up front so that when the appraiser does appraise it subject to completion, they really have a good picture in their mind of what you're going to be doing. Likewise, on the title ensures us in a first place position, and we want to make sure that the title is actually not only going to search the title, but they're going to check with the state construction registry to make sure that there's no work that's been performed on the property or no work that's been done already that would affect our lien position and affect you being able to insure us with a first lien position. Those are things that are really important, that are different in construction loans versus if you're buying an existing home. So just know that those are some additional things that take a little bit extra time, and it adds on to the overall time that it takes to do these. The final thing is when we issue, once all of that information is in, so once we have all of your financial information, we have all of the appraisal, the title, everything's collected and in, we have all the information from the builder, we'll issue what's called a final loan approval. And at this point, really, we've evaluated everything and we're ready to go ahead and formalize and put this construction loan in place. And that's when you'll close and you'll go to the title company. The closing of the title company takes typically about 30 to 45 minutes, depending on how many questions you have. You will actually, a couple of days before closing, you'll actually get a set of the closing documents and you'll be able to go through and evaluate those things. But this is when, once all of these closing documents are signed, at that point, it takes usually about 3 days before the closing or before the title company gives us clearance for you to start construction. It's not given immediately. So you'll sign about 3 days later. And during that time frame, what's happening is the title company is actually doing a last minute check on everything. They actually visit the property itself to make sure that nothing has happened on the property. They make sure that there's no dirt that's been moved, no work has started. They also check with the state construction registry to ensure that no liens have taken place, that there's nothing inhibiting us to being in a first place position. So there's something that's going on. It's not just a 3-day waiting period. There actually is stuff that's being done to ensure your position as a homeowner and our position as a lender in a first place position. So once that happens and we get clearance from the title company, we're ready to go ahead and start construction. During the course of construction, when periodically during the course of construction, funds will be needed to pay different providers, whether it's a subcontractor or a supplier. And those are called draws. That's how you access the funds on the construction. Those draws are handled by our loan administration department, and you'll enjoy working with our loan admin department. They do a great job. And the way that we set it up is we set it up so that typically we want you to do about 1 draw a month. Now, initially, we always do a little bit more at the very start of construction. We issue probably 2 or 3 in the first month, just because we know that there are things that you're required to do. You're required to put deposits down on certain providers, certain suppliers. When you order things, when you order your cabinets, they want a deposit. When you order your flooring, they want a deposit. And we recognize that. When you order your lumber, they want a deposit. There are all sorts of things suppliers that want deposits, and we recognize that, and we'll go ahead and issue those. You're in conjunction with your builder, you'll provide these draws to our loan administration department. Now on those draws, we require not only, it's a form, not only who's getting paid, but we also require an invoice so that we can show that the things that are being done to your home are actually the things that are being billed. It's amazing how often that gets confused, especially some of the builders that are working with multiple job sites. We want to make sure that we're having the property that is being built is actually the property that's being billed for, or the charges are being charged for. So we just double check and make sure that everybody's doing their job and everybody's making sure that they're accurate in their billing process. So, and hopefully that gives you an idea of how the costs are. The biggest thing that I can tell you through all of these things, I'm kind of pushing through this pretty quickly, but biggest thing that I can tell you is if you have questions through any of the process that you're going through building a home, stop and call us. Give us an opportunity to help answer. We love doing construction loans, and this is something that we enjoy, we're passionate about, and you can pick up the phone and call that direct number at the 481-8840 and get a loan officer that will answer those questions at any time. There is a question, and I'm going to go ahead and pause here for just a minute and answer. There was a question that came up. I'm going to have you scooch up okay. So the question was, can the closing costs be built into the loan, or must they be paid cash? May we use the equity in our property, if any? Terry, that's a great question. The answer is absolutely yes, you can use the equity in your home. That equity in your home / property, I know you're talking about the tear down, but you are more than welcome to use the equity in, and if you have sufficient equity, it may be sufficient to cover everything, the required investment, the minimum required investment. So it just depends on what you're looking at as the overall cost of the improvements and cost of the demolition and rebuild versus what your value. If you've got sufficient equity in there, you may not be required to come in with any more, and it would be enough to cover all of those closing costs and equity. I hope that answers your question. And then the next question is, are you able to do a pre-approval prior to working with the architect so that we have an idea of our budget? Absolutely. That is your very best idea, seriously. It's really important to know what you can qualify for before you go and talk to the architect, because seriously, it would be so sad if you went and talked to the architect and you came back and he said, here's this lovely home and it's $800,000, and you come back and they're qualified for $6 million. It would be really sad. And so my biggest suggestion is, if you have any questions whatsoever, you always want to consult with a mortgage consultant first and find out what you qualify for before you go any further. Then you have a guideline. So one of the questions that came up is from Chris. She says, I shouldn't say she, sorry, he or she, that's one of those names, sorry, Chris. What do we see the rates doing in the next 6 months? You know what, I wish that I had a crystal ball. I would be absolutely never have to work another day in my life if I could project that. You know, rates have been going up, obviously. Everybody's seen it the past couple of months. We've seen an increase in interest rates, and it's been kind of a steady. I would hope that we see kind of a leveling off and a stabilizing, but really it's something that is up in the air. We really don't know. And my hope is, historically, you know, that we see it level off and kind of calm down a little bit. I don't see them dropping off and reducing, but I do see kind of a leveling off, hopefully in the next 6 months. I hope it doesn't take that long, Chris. I hope they level off before then. Another question. So the equity that you are talking about can be from the home you are still living in while building. Yes, Jenny, that's what I'm referencing. So what I'm talking about when I'm referencing that is, we had a question earlier that says, would this type of a construction loan work for a complete tear down and rebuild? And in that situation, you have an established equity position. Let me just give you a what if scenario really quick. So if you're living in a home right now and the home is valued at $250,000, part of that value that's established to $250,000 is the land itself. And so if you're talking about taking that home, demolishing it, and rebuilding it, even if you demolished it, even if it burned to the ground, you still have that value of that land. And so the equity, your equity position is based off of a couple of things. When you get it, say you're going to rebuild this home, and now you're going to put $250,000 into the rebuild, and now your value is going to be $600,000. So you went from a home of $250,000 to $600,000 with only putting $250,000. That means you have a significant equity position. If you only owe $250,000 on it and you have a value of $600,000, and every scenario is different, but that just gives you an idea. You do have equity built in right now. Your equity might be big and it might be small. If you have a home that's valued at $250,000 and you owe $240,000, you only have $10,000 in equity. And that may not be enough if you're going to be building another $250,000 into it. You may not have enough equity to cover that. But if you have a significant equity position now, it would cover your equity requirement for the overall build. I hope that's a little bit more of an advanced question, Jenny, and I apologize. And I know that Terry, you too had questions. I apologize, and I hope that that gives you just a little bit of insight. My suggestion is those are really more advanced questions, and give us a call and we'll run through some actual scenarios for you so that you have an idea. The question from Eric, that's a good question too. Can you get a pre-approval for a construction loan even before picking out a piece of property? Absolutely, yes, Eric. We prefer to actually do it in that order. We prefer that you come and sit down and talk to us first and give you an idea of what you do qualify for. And we can give you a pre-approval letter that says this is how much you're pre-qualified for. We can give you an idea of what your requirement for out-of-pocket expense is. It really gives you a lot better position, a lot better idea of what you're looking at. So that really is the very best way to start it. So, okay, back to our present, but where we left off was the draws. And the next thing, once we finish, if the home is 100% finished, and you're ready at that point to go ahead and roll over to the long-term loan. If you've closed on a one-time close, then you're only going to be required to sign just a few documents to convert it over to the long-term financing. If you've done a two-time close, then this is where you're going to be signing your long-term financing documents. We would start when you're about 30 days from the home being completed to updating all of our information that we initially started with. So we'll update income information. We'll update, just to make sure that everything is still the same, we'll update your credit report, just making sure that nothing has changed. So this is where, once the home is done, this is where we'll convert those over. So we're going to cover just a couple of do's and don'ts. So some of the do's that you need to remember through the course of construction: check with your mortgage consultant before you make any changes. And when I talk about changes with anything, changes with income, changes with credit, changes on the home itself. Anytime there are any changes, we really want you to keep us informed and keep us involved with it. And also keep in touch with your builder through the construction process. I always kind of laugh a little bit when it comes to this. I can't imagine building a custom home and not keeping in touch with your builder. And yet I'm always surprised how some people just don't check in very often. They figure that they've got it, not a problem. And I've built 3 homes, and I'm telling you, I was out there all the time, every day. And I'm sure that my builder wished that I didn't check in as much as I did, but I wanted to see every day the progress that was going on. The moral of the story here is making sure that you contact us with any questions so that we can make sure and have this a good experience. So some of the don'ts, because you know, if you have do's, you have don'ts. Some of the don'ts: do not start construction. Don't do anything on the property prior to the construction loan being recorded. It is really important that I can't say that enough. This ensures, before construction begins, we have to ensure what's called a first place position. And that means that the deed of trust is the very first lien that's recorded on the property. And anytime anybody starts before then they have a prior lien right. And so it's really important that we address that no construction starts prior to the construction loan being recorded and we give you the go-ahead. Second, don't incur any new debt or increase your current debt that's already there. It's really important to know that anytime you do any of those changes, it affects your overall, sorry about that, it affects your overall qualifying. And we want to make sure that this is a great experience, and it would be really bad if you were during the course of construction, and we all love Home Depot, and we go to Home Depot and they say, open it to Home Depot card and you can get 6 months, 0 interest, and it's going to save you so much money, and you're so excited, and you do it and you don't qualify for the long-term loan. That would just be tragic, and I've had that happen. And so just know that don't increase any new debt. And the moral of that story, that part of it is, if you do need to, because there are all those things that come up, if you do need to, just please contact your mortgage consultant, go through the numbers with them, crunch the numbers with them, and make sure that it's not going to affect your ability to qualify. That really is the most important thing. Don't change your income. I've had a couple of people through the course of construction that have gotten opportunities for advancement, and they were going to make a move, and it would have affected their ability to qualify. This one comes back to, again, the same thing. I've said this a million times. Talk to your mortgage consultant. Make sure that if you do want to make a change, that it's not going to change your ability to qualify and finish the construction. And then lastly, don't deviate from the plans and costs. If there's something that comes up, or if there are some significant changes that you want to adjust through the course of construction, let us know. We've done an appraisal, and the appraisal is subject to the original plans and costs. And if things change when the appraiser goes out, it may change the end value and may affect your qualifying again. And so we want to make sure that anything that is done on the property, any change, any adjustment to the plans, that we're involved on it. Second to that are the costs. Now, we get from time to time, we get questions that come up of what happens if the costs are more? What happens, are we still going to be able to qualify if the costs are increased? And the answer is, we try really hard up front to evaluate and to help look over your cost breakdown with your builder to make sure that everything is covered. But inevitably, there are things that come up. If it's a surprise, if it's a complete surprise, if there's things that changed, we understand those, but we require what's called a contingency line item. So what we're going to do is, with your builder's going to provide a cost breakdown for the actual hard costs of the structure itself. We're going to require an additional 5% be put on a contingency line item for cost overruns or for expenses and unexpected expenses. Now, that doesn't mean that if you have put $3,500 aside for your appliances and you decide that you found a fridge that's $3,500 and you just have to have it, which that happens, that all of a sudden you need another $2,000 to cover your stove and your dishwasher and your microwave, and you don't have that money. Those are extras. Those are things that you are affecting, and those are things that you can control. What we're talking about on the contingency, and you'll be required to pay those things. If it's just an overage, you're going to be required to cover those. But if it's a true unexpected overage, so you get through and a bill comes in from a supplier that you thought was going to be $10,000 and it was $12,000. That's what that contingency is for. It's for unexpected expenses and unexpected issues. So there's a difference between those, and we do try really hard to help you expect the unexpected through construction. So hopefully so again, the don'ts. Don't start anything on the property before the construction loan is recorded. Don't change your debt structure, so no new debt. Don't increase any of the existing debt. Don't change your income. Don't decide that now you're building and you want to quit your job. We don't want that. And then don't make any changes or deviations on the original set of plans and costs that were submitted. And the last is, do make sure if you do any of these or any of these come up, that you do talk to us and let us know. There's a question, do we lend in all 50 states? That's a good question, Lisa. I so wish I could tell you yes, but the answer is no. We only lend currently in the state of Utah. I wish it was, and I wish it was in Hawaii, because I would love to have to go to inspections in Hawaii, but that's a big No, in Hawaii. Only in the state of Utah. So there are a lot of questions that come up, and those are the basic information that I've covered. Hopefully has given you a lot of answers to questions you may have had. What we're looking at now, I want to just cover briefly some information on lot loans. We do, as I mentioned earlier, we do offer lot loans. And the lot loans for us, we require a 30% down payment on the purchase of the land. And we finance the balance over a 15-year period with a 2-year call on that loan. We really don't do lot loans for a long term. We want it to be a temporary loan to help you acquire the land, with the idea that in that 2 years you would be putting together a set of plans and a cost breakdown and getting with a builder to move forward with the construction. So that's why the 2-year call is on. So again, 30% down on the land, 70% would be financed over a 15-year period with a 2-year call on that. Just to give you an idea of what we're looking at on the lot loans. So we have a few more questions, and I would just encourage you, if you have questions, I'm just going to kind of go through some questions now and answer. So one of the questions was, what do current rates look like? So Terry, good question. On the construction loan itself, our construction loan is right around 4.49%. Again, remember the construction is interest only through the course of construction. So 4.49% on the construction, but on long-term rates, it depends on what you're looking at. On conforming rates, they're somewhere right around that 4.5 to 4.65. And every situation, I hope you understand, Terry, every situation is different. It depends on what your credit score looks like and what the loan to value. Those are the two biggest determining factors on interest rates. But they range right now somewhere between that 4.5% to 4.75, you know, and some as high as, depending on your FICO score, some as high as 5%. But just under that 5% mark. We haven't quite seen that yet. One question from Jenny. So does the lot loan roll into the construction loan? Yes. It doesn't roll into it, but we do roll it from the construction or from the lot loan itself. We do a new loan as the construction loan. So it's not a rollover, it's just a new loan. Hopefully that answers that question. I totally killed that one. Sorry, Jenny. Another question, is the long-term rate finalized at closing or once construction is completed? Sorry, I missed that. You know what, Chris, don't worry, you didn't miss it. So we have two options. A one-time close where the interest rate on the long-term rate is actually locked up front before construction is started. So single time close, it would be locked up front. And if you do a two-time close on a construction loan, it would actually be locked just before the completion of the home, before you would sign your final closing documents on the long term. If you have questions on that further, Chris, and for all of you, just so that you understand, we actually will be sending out a follow-up email to all of you with a link for this construction loan presentation. You'll be able to watch this again and listen to it. You don't want to watch, but listen to it again, just so that if you did miss anything, you'll have that link that you can reference back to. So, and if you do have questions, if I didn't answer it, or if you're confused on that, Chris, I would encourage you, again, call us at that 801-481-8840, and we'll answer any of the details and questions that you have. We do have a couple more questions, and I'm going to go through those. So one of the questions that we had is, what's the minimum credit score requirements for construction financing? On construction, we do adhere to Fannie Mae guidelines, and Fannie Mae says that if you're in the conforming amount, so if you're going to be doing that one-time close, your minimum FICO is 620. If you fall into a jumbo category, we do require that your FICO score is 700. So if anything over the 600,300, you're going to fall into a jumbo category, and you will be required to do a two-time close, and that means your minimum FICO score is 700. We will look at, on a case-by-case basis, a FICO score that is lower than that for a jumbo, but we really want to look at what the compensating factors are for that. We're going to look at, what's causing that credit score, what are the issues with that, what can we do to help you get those credit scores up. We will really work hand in hand with you. If you have some credit issues, we'll look at that and see what's causing those, like I said, and we'll do some what if scenarios. If they're this and we want it to be this, so if you have a 680 FICO and we want you to be at 720, we can put some scenarios in and say, what do we have to do to accomplish that? We've got a lot of ability to be able to see those what if scenarios, and so let us work with you. Give us a call and let us help you through that scenario. Chris, you have a good question. Are there options to improve credit scores? And hopefully that answered your question. We really do want to work with you hand in hand to try and help you improve and put you in the very best position financially with this mortgage, with the construction loan and the long-term mortgage. We want to do the very best we can for you. So work with us and let us help you through that. There was a question earlier, does this work for renovations? And yes, this is a great option to do a construction loan. This is actually the product that we encourage. But we do have a question regarding whether if you're doing a renovation versus if you're doing improvements to the home. And let me just clarify that. Improvements would be like if you're finishing a basement. If you're going through and finishing a basement, would this be the loan for you? And it depends on how much you're looking at spending and if it's really going to have a significant impact on the overall value of your home. A basement is typically something that we'd encourage another product for you, a second mortgage or even a home equity line of credit. Those are two products that would be really good for that type of a product, for that type of a need. But if you're doing a significant renovation, if you're going to be doing a knockdown and rebuild, or if you're going to be doing a significant add to square footage of the foundation or things like that, then this is the product for you. This is the type of product that's going to really help you accomplish that goal. So hopefully that addresses that. Let's see. One of the questions that we had earlier that I'm going to bring up here, I felt like it was a really good question, was what time frame can you expect for a construction loan? How long does it take? As I mentioned earlier, there are things that are during the construction loan approval that we look at and that take just a little bit longer. So typically a construction loan takes somewhere between 4 to 6 weeks. And I'm going to say probably push to that 5 to 6 weeks. There are a few things in there, and that really depends on how much cooperation we get from the builder and from you providing us information. And once we get that information, but we really try to push these through as quickly as we can. But realistically, you need to prepare for 5 to 6 weeks to get this from start to finish where you're ready to go ahead and start construction. And that's considering that you come in and that you've got all of your plans and specs and everything and all the costs arranged and the contract with the builder, everything is in line. So hopefully that helps. So 5 to 6 weeks is what you can anticipate for a time frame. Another question, is there a debt to income ratio in order to get approved? That's a really good question, Jenny, thank you. There are debt ratios, and they echo the same thing as you would be buying an existing. So right now, and the debt ratio to income has kind of changed over the years. It used to be 2 ratios, and now there's just kind of 1 ratio overall. We really want to hold that ratio to a 43 to 45%. We really don't want to see you go any more over that. And the reason for that, Jenny, is that if there are increases in the market throughout the course of construction, or if there are some things that come up where you actually need to qualify for more because there have been cost overruns or there have been other issues, we really want to have some shimmy room in there for getting you qualified and make sure that we can, again, in the end, we can get you in and qualified and happy with the overall process. And so we do require some pretty tight debt to income, and that's not even really tight. Some of them are holding them to 40%. So about 43, 44%, somewhere in that range. Hope that helps. Question came in, are there options to improve credit scores? What we try and do on that, Chris, and I know I addressed credit earlier, but what we try and do with that is we try and see where you're at currently, and then we do a what if scenario with our credit agency to see what we can do to improve it. We can actually put in a scenario and say, if you're here and you want to be here, what do we need to do? And it spits us out that answer. It's kind of cool, actually. So hopefully that helps and gives you an idea. Just the moral of the story, I know I keep saying that, but is really let us help. Let us do everything in our power to help you through the process. Let's see. One question that has been asked is, can we build on a multi-acre parcel and then subdivide the parcel after? No. The easy answer is no. The reason for this is it becomes very difficult to subdivide and to get parcels released. And it's not just with the lender, it's not just with us, it's actually with the city as well. The city has to approve subdividing and all of these things. And so it's really important, if you are going to be buying a piece of parcel, or a piece of property, sorry, a piece of property that you're going to be subdividing, you want to get that taken care of before you start construction, before you start your process for the construction loan. And I'm going to take it a step further. You actually have to get it taken care of and done and recorded and finalized before we pull a title policy, because the title policy is going to define the legal description. And so you want that to be taken care of and done. Bring us the one parcel that you're going to be building on, and we'll move forward from there. So if you want to subdivide it, get it done before you ever come and talk about construction. That's really an important thing. So some really, really great questions that have come up. I appreciate that. One more question. Do you have a product for building a detached addition? Yes, Terry, that's a great question. And that's what a home equity line of credit or a true second mortgage would be a great idea for that type of product, or for that type of an addition. If it's going to be a significant addition where it's going to cost a big bundle and it's also going to add a big value to your property, we may have to push you from that home equity line of credit or from that second mortgage to a construction loan. But initially, we're going to start you there, and we're going to try and see if we can work with that, if that's the best product for you. But in the end, again, we're going to give you options. We're going to say, here's option 1, 2, and 3, and then you need to choose what's best for you, because in the end, Terry, you're going to know what works best for you financially as well. So that's a really good question, though. So I don't have any more questions. I hopefully have covered everything. Just again, I know y'all know where to find us because you found us on the webinar. But again, that 481-8840 is the line that you can reach all of us. We'd love to help you answer any questions you may have, and we'd really love an opportunity to help you with your construction. This is something that I'm personally passionate about. I enjoy it. We've built 3 homes, and it's a fun thing. It's also very stressful, and so really give us a call. Let us help you through it, and work together with you to accomplish a goal. We appreciate, again, my name is Jennifer Young. I'm actually the sales manager here at the credit union. If you have any questions, you can contact me on that same line, that 481-8840. And Terry, just under the line, you have one last question, and I'm going to wait for that question to come in so that I can address that for you. That's a good question. What's the benefit of using the credit union as opposed to a broker? You know what, Terry, I'm going to totally tell you that the credit union is the only way to go. But fortunately, I've worked for both, and I can tell you some things that you can anticipate. Brokers don't typically provide construction financing. It's not a product that they have on their menu of options that they provide. So second to that, you're typically going to pay a little bit more because a broker is fee-based, and where a credit union is relationship-based. We want to not only help you with the course of construction and the long-term financing, but we also want to help you buy a car, and we want to help you, help with your kids' education, and we want to help overall. So we're a full service lender, and so we have an opportunity to build an overall relationship, and that's what we're looking for. So that's what you're going to find, is you're going to find that our fees are typically going to be a little bit lower than what a broker is. You're going to find our rates are going to be a little bit lower. And overall, you're going to find that our relationship is more important to us than just one transaction. We really want to build an overall working relationship for you for a long time. So hopefully that answers you. And that was, what a great way to end. Terry, thank you. I appreciate that very much. That was a great way for us to end our presentation. Again, you guys are going to be receiving a copy of the link so that you can go ahead and listen to this again. And if you have any questions, just reach out to us and let us know. We look forward to helping you. Thank you so much. Enjoy your afternoon. It's a beautiful day out there, and hope you enjoy it. Thanks.